So yeah, today I just want to talk about just the overall market conditions. I've seen a lot of conflicting advice and just the commentary. No one really seems to know what to do right now. It's kind of like an unprecedented time. You've never had like a leader of a country like the US, which is so important for like the global economy and also just like the US stock market, obviously, um, be so what's the right word? So like challenging of the norms.
Mhm.
Like, you tariffs have kind of been put in the locker for a long time, always seen as, just a general bad thing. Like I remember being taught in school that tariffs were something that were tried, and then we realized economically they just are worse than free trade, and that's why, overall like people don't use them as much anymore. Seems like Trump just completely went against that. And I don't know. I think the market doesn't really know how to react right now. We're seeing a bit of a dip. I see people talking about buying the dip now. I see other people mentioning, it's only at like pre-election levels, like it's not really a big drop. I see other people saying that the economy is gonna crash for a long extended time because of what Trump's doing. And they
Mhm.
say they don't want to buy the dip, they actually want to wait it out, or this time is going to be different, kind of like that idea. So yeah, I just want to know like what your guys' opinions are um, of the recent market conditions and how you're feeling right now.
Mm. Is yeah, the phrase, is shit hitting the fan? Is this the start of like a protracted decline in terms of real productivity, in terms of GDP, in terms of so on? And there's a stock market reflecting that. So in addition to the material impacts of tariffs, higher costs, there's a real elasticity, it's price elasticity. As prices go up, consumption goes down. There's concern about excessive, additional spending, stagflation's on, people think that stagflation could happen where the economy stagnating and there's inflation at the same time, which is like a real big double whammy for people. There's a lot of concerns. I think the uncertainty about how things play out alone has major consequences. So in uncertainty, people don't like uncertainty. We're uncertainty averse. There's other indicators like the VIX. And it's a forward-looking measure that's kind of considered the fear indicator, which is high now. And this is all very normal. And without getting too political about it, Trump is, as you said, Cam, he's shaking up norms. He's putting things out that seem to really contradict standard economic policy of this is going to be bad for consumers. Like, yeah, I don't think there's a lot of dispute about when you increase prices and you create cross-border frictions. I don't think there's a lot of dispute about that. My question is about, well, how protracted is the trade war? What is the intention of this? When you look at Trump as a specific negotiator, he has this sort of, I don't use the term like shock and awe, but he has this like hit them hard and then throw them off balance and get them in a different negotiating position. You see it over and over and over. If you do it too much, you do lose credibility, which is scary in the things that's happening on the international agenda. So I personally, my perspective on it is it's more of a body check, throw people off, get them uncomfortable, uh, create a downturn. And then if you think about the need to show returns is like, I'm sort of hovering over here. Um, to show that recovery, I'm wondering if that's part of it, is you actually bring it down in order to have an upside, which is not too dissimilar from some of his real estate strategies of like bankrupting things and then buying it for nothing and then getting the upside from it. Like it reminds me of that. Those are some of my thoughts. Some of my thoughts. If I'd love to hear what your thoughts are, Murali.
It's hard to really take into account these sort of macro trends. Um, that's and isn't it kind of one of the big things that economists say is like trying not to time the market. I don't know. What are your thoughts on like that? This sort of feels like it applies here, right? Like
Mm,
that's kind of what keeps in my head. And I've heard you say that. I've talked to other economists like don't try to time the market. Isn't that essentially what we're doing right now? Like if you're interested in something. I don't know. That's kind
mm,
of my and that's kind of what's causing me trepidation right now is I'd like to invest more, but am I trying to wait for the bottom of um of the valley on this one.
Mm. I'm so
I
glad
feel
that phrase is so good. Don't time the market. Well, if you're not good at time the market, don't time the market. If you're good at timing the market, and you're that tiny minority of people, then this is a great opportunity. Cam on a previous call was like, "Hey, I've actually shown the ability to buy dips." So I would say the caveat is most people cannot. Those who can need to have a strategy. When are you coming in? When are you coming out? Like I think it really depends on your own unique ability. So I wouldn't say across the board don't do it. Like they say time in the market is better than timing the market. And historically that's been true with the S&P. But individually, if you're listening to this, like have an analysis done. See if you're actually good at it. You might be good. I mean, I've shown some of my accounts have been quite good. And there are epochs where I wasn't as good. So I'm curious what you think, Cam, and if you want to take a look at your analytics.
Well, one thing I want to comment on first is that
Mhm.
I feel like the whole idea of timing the market really mostly applies to um, like trying to time a drop. Like, say you feel like the market's overvalued and you start selling a bunch of stuff thinking that everything's going to drop. I feel like that's really dangerous because markets have been shown to just, they can stay in high valuation levels for long periods of time and you can miss out on a lot of returns.
Mhm.
I
Mhm.
feel like when you're actually in a drop and you're in a crash, then yeah, definitely try to time the market, throw all your money in. And I mean, maybe the part of it is that, if a drop starts, you might want to like timing the market might be like waiting to buy, like probably you want to just start buying right away when there's
Mhm.
a drop. Like I could see that, like missing out, thinking it's going to be a bigger drop and then it's not.
So,
But yeah,
okay.
like
Were you saying, so it sounds like you're talking about the invisible portfolio. So you're saying, so there's two things. One is get out before the drop, which is the invisible portfolio. So you're out, you sell it, and then if you're good at getting out before price drops, then your invisible portfolio should be below your actual portfolio. Is that right, Kim?
yeah, I think it's just a really dangerous thing to try to like say the extreme example would be sell your whole portfolio because you think the market is going to crash.
Yeah.
And then, the market could go on for another 2 years, continuing to go
Mhm.
up, and you're just missing out on all of that. So yeah, yeah, invisible would be like the perfect indicator of this. It's just like, when you fully sell out of something, does it tend to outperform what you've actually been holding on to?
That's
And
it. Panic
yeah,
sells are in there too, right? I mean, if you just, like you said, you like freak out and dump everything, then your panic sells will be here. For me personally, just for people that are watching this for clarity, it seems like I have sold future winners, like looking over the period from 22. And then there seems to be more of a convergence. But yeah, I sold some winners that did very well after I sold them, which means that I would have been better not to sell them. And we could look back a bit deeper through like we have a back end that shows deeper insights. It seems to be a convergence, but yeah, that's a very big difference. I mean, to go from 56 to, in this period, that's massive. So sorry to cut you off there, Cam. I just want to give some context where some people, like we have somebody who we analyze, a portfolio manager who's, if you look at his invisible, it's like hugely negative. This guy's consistently over a 10-year period been able to part with stocks that have a bad future and like very, very cleanly. So I just want to kind of give some context for this. Sorry, Cam, go ahead.
yeah, and I feel like what you were talking about with loss chasing, um, like this is just such a good metric to figure out if you're actually good at buying the dip. Like if you've done good in the past about when
Mhm.
you decide to go in. Um, and yeah, I think it's hard because this is like a different kind of market. Like when you're in a crash, you don't get to experience that much. Like dip buying is a little different in like a market crash than in like regular market conditions. So yeah, I think maybe there could be like a grain of salt where it's not exactly applicable. But like, yeah, if you've experienced a market crash before, like you experienced COVID and you show that you made really good investments there and benefited a lot from it, then
Mhm.
I think the moment you start seeing a crash, you need to be immediately looking for where are the opportunities, do I want to take single stock risks or do I want to just invest in the index as a whole?
Hmm.
So yeah, I think that's where I am right now with this. Like, I don't think the S&P has fallen enough where I am looking to buy it specifically. I think right
Hmm.
now the best opportunities are single stocks that have been hit overly hard. Um,
Hmm.
Ones that maybe aren't affected as much by tariffs that have kind of been pulled down by the general market drop.
Hmm.
But
Hmm.
yeah,
Okay, so if you were to put in like a guided investment, like a trade journal on Profit Wall Street, it sounds like you just put a hold on all of your positions. If we're making a decision today, neither buy nor sell in the hold. Like, so what I would say, I don't want to put words in your mouth, but I would say something like, I don't think we're at the bottom of some of these stocks. I don't want to trigger taxes on the gains that I have. I did sell Tesla the other day though. I just the plummeting of it. I mean, I was up maybe 100% on it, and I didn't want to lose all those gains. I just thought, well, I need to part with it. Yeah, and it's gone well below what I would have paid. So I missed the, I didn't catch a falling knife. I missed the losses. Uh, yeah, you incur some taxes when you sell, but it's better to preserve your capital and fine. You incur some taxes. That's part of the game. It's not the end of the world here. So if you went through and did your trade journal, it'd be a bunch of holds. I'm
yeah, I
tempted to
think
short, but I'm not that confident at this point about any particular single stock.
I think for me it would be a lot of holds with me putting that I need to do more research to determine what I need to do with that position. Because I feel like there's probably some things I'm holding right now that are just awful to hold in these market conditions. And then there's other things that have been really beaten up that I should probably be adding to my position.
Hmm.
So I think just a general portfolio review is like really good to do right now.
Hmm.
Um,
Okay, well, why don't we do that next? We're just about
yeah,
at time here, but that would be really cool. Like, I think this is an opportunity. Again, you're not putting all of your money behind it. And I think one of the points that's worth mentioning is this a learning opportunity versus a big wealth making opportunity? Like, you have to think about it that just regardless of why things are happening, it's a good experience to stay calm, have a process that deals with whatever's going on, and to be able to parse it versus just letting your amygdala run the show and just say, I'm scared, I'm freaking out, I'm out. And that's one of the major reasons that people have these massively negative invisible portfolios because they freak out and they sell whenever any slight things going on. And you look back at the long stretch of history, you could say, well, actually, the long stretch of the S&P, any dip would have been very profitable retrospectively. So we know that. Okay, well, keep a cool head, invest wisely, and we will talk soon.
Like and subscribe.